welcome to Switzer Investing Insights, brought to you by nabtrade. And today we want to talk about the hype around hybrids. Are they really worth the risk? Paul?
Well, let's start with what a hybrid security is, Pete. It's a bit like the hybrid motor car, which we all know is a cross between petrol-driven and also renewable energy. Well, hybrid's a cross between a debt security and an equity security. Look, debt-like features, and you get a regular distribution, and like a bond, if you invest $100, you hope to get back $100 on redemption. On the equity side, Peter, it's classified as capital by the issuer. They put it in their balance sheet. That's why they do it. In the wind-up, you rank pretty well near the very bottom, so chances are you won't get your money back if the issuer is wound up. Distressed circumstances, you get exchanged back into ordinary shares, so your note is actually converted into ordinary shares. And like a share, they are tradable and issued on the ASX.
All right, so those are the key features of a hybrid security, Paul.
Yeah, let's add to that. It's an unsecured note with a face value of $100. It pays a gross distribution. That's at a fixed margin over a floating benchmark interest rate. We'll come to that in a moment. Distributions are usually quarterly. They're reset each quarter. They're usually franked, which is nice, adjusted for franking credits. They have a mandatory exchange, so if the issue goes this long, you will get exchanged into ordinary shares. I mentioned that, and typically that's in about 6 to 10 years out. Most of the issuers also have what's called a call option, allows them to actually pay you out early.
And most of them do that.
And most of them tend to do that, and should get back your $100, and that's generally about 4 to 8 years out. That depends on the issue. And then there are these trigger events, Peter, which you don't really want to come across, but that's when the regulator gets involved and says, this bank is in really serious trouble, and then you will get exchanged into ordinary shares.
So give us an example, Paul.
Well, let's take to the distribution as the first part. So I mentioned that it trades, you get paid a fixed quarterly margin. That's usually priced over the 90-day bank bill. Now that's the sort of the key benchmark short-term interest rate in Australia. This is the chart over the last 10 years, Peter, and you can see that it's been going one way, right? It's been going from over 5%. Today it's around 0.05%, 5 basis points. It's almost nothing.
And BBSW, Paul?
That stands for the bank bill swap rate. So, that's the way it's set, but it has been going down. Now, all the hybrids are a fixed margin over that. So that's the bank bill rate's the floating component. There's a fixed margin over that. So let's take an example. Let's assume that the hybrid's issued at a fixed margin of 3.4%, and the current 90-day bank bill swap rate is 0.05%. For the first quarter, you're going to get a gross distribution of 3.4% plus that 0.05, so 3.45%. Don't leave that out. The actual cash distribution you get, because these things are fully franked, you actually in cash get 70% of that. So you'll actually only in cash get 2.42%, but you will get the franking credits on top.
And of course the company rate is 30%, and that's why it's 0.7, and you get it as a tax refund. Okay.
Now, I mentioned they float. Now, let's say that interest rates do go up. Let's say the Reserve Bank, we get really strong growth in Australia, and interest rates go up in Australia. Maybe not in the next year, but a few years out, the bank bill rate goes up, say, to 1%. That means the gross distribution will now be 4.4%. That's the 1% plus the 3.4%. And the cash distribution will be 70% of that. That's 3.08%. Now, interest rates could still go negative, Peter. It's not
it's possible.
It's possible, unlikely. And of course, if that happens, the BBSW rate could also go negative. And in those situations, let's say it goes to negative 0.25%, the gross distribution will only be 3.15%. And the cash distribution will be 0.7%.
So hybrid players would like to see interest rates rise rather than fall?
Potentially they'd like to see interest rates rise. But look, again, we've got to compare that to term deposits, which are generally under about 0.5%, and because that's a gross rate. On that sort of basis, these look pretty exciting.
Okay, so let's talk about all these issues like exchange, the conversion, the redemption, the repayment.
Yeah, look, it gets a bit complicated, but you need to, if you don't understand it, you need to follow this. So, look, there is a mandatory exchange. I mentioned that's typically about 6 to 10 years out. And if that happens, the issuer is required to take, for your notes, give you ordinary shares in the company, right? That's probably not going to be something you're going to want. There's a couple of tests.
The share price would probably be falling because the bank's in trouble.
Well, may not be the only reason, but let's just assume that happens. There are some tests around the current share price and some protections, but if that happens, you're going to get ordinary shares. It also is a test, if they can't do it on the actual nominated date, they retest it every quarter. So at some stage, if you get to that date, You're either going to get shares or it's going to stay in the situation where at some stage they're going to give you shares. You will get $101 back of ordinary shares, so there's a small bonus. Yeah. What we really focus on typically is the optional exchange. This is when we hope and we expect that the hybrid note is going to be exchanged.
And most are.
And most are. Typically this is a couple of years shorter, so about 4 to 8 years out, depends on the issue. And it's at their option. They don't have to do it. So, and most...
The contract is one way, isn't it?
The contract is one way. Most of these haven't... Actually, what's happened is they repay you the $100. Yeah. And that's how the market is largely assuming the hybrids will trade. Doesn't mean they will, but that's what the market expects to happen. Yep. Now, there are also a couple of other automatic exchange events, and these are called trigger events. They're called non-viability or capital trigger events. This is when the regulator APRA gets involved. And this basically means either the bank is really getting stretched on its capital ratio, or alternatively APRA is saying, sorry, we don't think you're viable, and the only way you're going to become viable is basically to convert all these things into fully tier one, full capital. You don't want this to happen, because if this happens, you're going to lose money. It's guaranteed to, because there's also some things set in the PDS that limit the number of shares you can get. And this wouldn't be a good situation to be in. But this is the risk of investing in hybrid securities. Yep. As we said before, this is a chart from Westpac about their current Capital Note 7. You're actually right down near the bottom in terms of the food chain. If the bank does get wound up, you're only just ahead of ordinary shares in terms of getting any money back. And to be honest, very rarely any money flows back to ordinary shareholders.
And this is part of the reason why a lot of advisors will tip their clients into bank hybrids on the basis that banks seem to be more secure than most other corporations that issue hybrids.
They're certainly higher regulated and have got much higher capital standards. But you know, this is a risk you take. You want to get a higher return, got to take some more risk, and that means the risk of loss is obviously higher. So let's talk about the risk. First of all, Peter, it's not a bank deposit. It's not covered by any government guarantee. This is not a term deposit, folks, right? It has no fixed maturity date. Now, I mentioned there's a mandatory exchange date, usually 6 to 10 years out, but that's when the bank should exchange, but it has to meet some tests. And if it can't meet some tests, it keeps on being retested every quarter. It could mean the security, they never meet the test, Peter, so it doesn't have a maturity date. If the issuer gets into serious trouble, or there's a crisis in Australian banking, you could lose some or all of your capital. I mentioned before there's a maximum number of shares you get on exchange. If that happens, you'll get a lot less than the current $100 worth of shares. Yeah. The other risk to bear in mind, Peter, is that, okay, we talked about the quarterly distributions, but they're discretionary. So that means the bank doesn't have to pay the distribution. And if they've got in a bit of problems, they won't pay it. Yeah. And they're not cumulative. Now, there is a protection to stop that discretion being misapplied, in the sense that if the bank can't pay a distribution on a hybrid security, then it can't pay ordinary shareholders any dividends. Yeah. Now, you've got to think of what that means. That means that ordinary shareholders probably aren't going to be very happy either, and the price of the shares is going to be a lot lower. Exactly so when that happens, you're probably also going to be losing money. And lastly, there are marketable securities. So if you do want to get out and go to the ASX to sell them, the market price may be less than $100. Now, we saw in the COVID-19 meltdown in March, the price of hybrid securities got absolutely pummeled. A lot of the securities that were trading over $100 went into the 80s and 70s.
That's because people were just trying to get rid of them. Supply increased, price went down.
Now, they've all come back over $100, but it does show you what can happen in market meltdown situations, and liquidity on the ASX may be poor. As always, we always caution about anything that's higher risk. Understand the investment. If you don't invest. Read the prospectus. Look at videos like ours. There's a lot more information about hybrids and things like the ASICs Money Smart website, which can really help you out. But golden rule in investing is don't invest in something you don't understand. Now, there are some current primary market offers out there, Peter. Bendigo's got paying a 3.8% margin for a term of about up to 8.5 years. Westpac's got an issue with 3.4%. And NAB has also got a Capital Notes 5 issue paying, which should be set at about 3.5%. Look, again, the big bank issues, they're the jumbo issues. I think despite the rate difference, they're probably more attractive from a marketability point of view than the Bendigo issue. And I think they're going to be pretty well supported.
Okay, you talked about the pros and cons of hybrids. Are you an investor in hybrids?
Look, I am an investor in hybrids. I treat them as part of my fixed income portfolio, probably the riskier part of that fixed income portfolio. So I use them in that capacity. Around this sort of margin, about 3.5%. That's about mid-market. I think that's about reasonably attractive. Obviously, but I understand the risk, Peter, and I know that, marketable securities, they can go under $100.
Okay. So that's Switzer Investing Insights, brought to you by nabtrade. Thanks for joining us.